In section 2, we talked about different theories related to dividend policy. In section 3, we will talk about the factors which impact dividend policy. What I'll do on this slide is run through the major factors and then give you the key points related to each factor. The larger concept here is that how does a company decide whether to pay a dividend, whether not to pay a dividend? If a company is already paying a dividend, how does it decide whether to increase the dividend or not? So here are the factors. A big one is investment opportunities. Clearly, a company with lots of investment opportunities, and by definition here we are talking about positive NPV or profitable investment opportunities. So a company with lots of good investment opportunities is likely to pay either low dividends or no dividends. That's why you will notice that young technology related companies will generally not pay dividends because they have lots of good investment opportunities. The second factor is the expected volatility of future earnings. If a company is already paying a certain dividend and the expected volatility of future earnings is high, let's say on average the company is expecting that earnings will be up, but the volatility will also be up. So considering the volatility factor alone, the company will be reluctant to increase dividends, because once dividends are increased, that sets an expectation with shareholders, and it is difficult, or it sends a negative signal when the company subsequently reduces dividends. So the major point here is that if expected volatility is high, then that would imply that the probability of raising dividends is low. Next point is financial flexibility. Generally what this means is that if a company does not pay dividends and has more money in cash and marketable securities, then it has higher financial flexibility. The company can then take advantage of investment opportunities. The company can buy other smaller companies. A classic example is that of a company that I worked for. If you think about Oracle, over the last 20 years, the company has done very well. It pays a relatively low dividend. It has a large amount of cash, and it uses that cash to buy other companies. So if Oracle wants to get into a new segment, rather than organically developing that segment, Oracle goes and looks for the market leaders in that particular segment and just buys them. Why can it do that? Because it is sitting on a large stack of cash. And that large stack of cash gives it financial flexibility. Had Oracle been giving out its earnings in the form of dividends, then obviously that financial flexibility would not have been there. Then we have tax considerations, which is a substantial point, and this I will cover over the next few slides. There is a learning objective that focuses on tax considerations, so it deserves attention on its own. Next point is flotation costs. I hope you know what we mean by flotation costs, but I'll still emphasize what this is referring to. Flotation costs are both explicit and implicit. When a company issues debt or when a company issues shares, then obviously there is a fee involved. The company needs to pay the investment bankers, there need to be marketing costs that have to be covered, and so on. Those are explicit flotation costs. Then there are also implicit flotation costs, in the sense that if a company issues new shares and if that is taken as a negative signal which brings the overall market price down, that would be an implicit cost. Obviously the company would not like the fact that the share price is coming down. So in an environment where flotation costs are relatively high, companies are less likely to pay dividends or less likely to increase dividends. Why? Because what the company would then like to do is retain or keep its money, and that money can be used for investment opportunities. If the company pays out dividends and then has a positive NPV project to do, it would then have to go raise money. And if that raising of money means high flotation costs, that obviously is not very sensible. So key point is, if flotation costs are high, then dividends are likely to be relatively low. Next point is contractual and legal restrictions. So here there are two sub-bullets, government rules and bond indentures. The rules related to how much dividends companies can pay obviously vary from country to country. In some countries, there might be a rule that a company has to pay at least X% of earnings out as dividends. In other countries, there might be rules such as the impairment of capital rule, which says that a certain amount of capital or equity must be maintained relative to total assets. So that obviously has an impact on dividend policy. We don't need to go into details, just recognize that the laws and regulations of countries will have an impact on dividend policy. And then something that you've seen in fixed income, bond indentures. With bond indentures, as we've discussed in another reading, bondholders will have an issue if shareholders get a very high dividend, because that then increases the probability of default. So there might be bond indentures, there might be covenants that say that dividends need to be below a certain level. So that will also impact dividend policy. Now, as I promised, we need to talk about tax considerations. Tax rates on capital gains and dividends vary from country to country. And clearly, the relative tax rate on capital gains and dividends will have an impact on the dividend policy of a given company. Very simplistically put, if you are in a country where the tax rate on dividends is very high, then chances are that companies in that country will tend to pay relatively lower dividends. Also, countries have their own rules with regard to taxes paid on foreign investments. So if you are a US investor with investments in Germany, then there will be tax rules in the US that determine how much tax you effectively pay. Given that you are already paying a certain amount of tax in Germany, then there'll be rules in the US that say how much overall tax you need to pay in the US. The learning objectives mention three main systems of taxation that impact the level of dividends paid by companies. Those three systems are shown right here: double taxation, tax imputation, and split rate. Let's understand each of these three systems. The first one, double taxation. This exists in a few countries. The most commonly cited example is the United States. And according to the double taxation system, corporate earnings are taxed at the corporate level and then taxed again at the shareholder level if they are distributed to taxable shareholders as dividends. Let's take a look at what this means. I talked about the fact that the United States has double taxation. Until 2003, and you don't really need to know these dates, it's just FYI. So until 2003, the tax rate on dividends was 39.6%. Okay, so let's see that for net income before tax of 100, how much effectively does the shareholder get? The shareholder is the owner of the company. So in this system, the shareholder is being hit twice. Once because the company is paying taxes, and two, because the shareholder gets dividends and pays taxes on those dividends. Let's say that the corporate tax rate is 35%. So straight away, the net income after tax as reported by the company comes down to 65. As I mentioned, the company belongs to the shareholder, so it is the shareholder that's taking this hit. Then, assuming 100% payout, the shareholder gets 65. And then, if the shareholder tax rate is 39.6%, then the tax paid by the shareholder on the dividend is 25.74. The net dividend is 39.26. $100 of earnings before tax mean that the shareholder gets 39.26. So he is paying a huge 60.7% tax. I took you through the long-winded procedure. the quick way of calculating the effective tax rate is to take the corporate tax rate of 35% plus 1 minus the corporate tax rate, which in our example would then be 65 or 0.65, multiplied by the individual's marginal tax rate on dividends, which in our example would be 39.6. In 2003, the tax rate on dividends was reduced to 15%, and then the effective tax rate came down to 44.8%, and you can see where the calculation is coming from. Also, just make sure you remember this formula and know how to use it. The second system is the tax imputation system. This is used in Australia, New Zealand, and France. Taxes on dividends are effectively levied only at the shareholder level. And how does this work? Let's take an investor with a marginal tax rate of 15%. If the pre-tax income is 100, and let's say we are in a country where the corporate tax rate is 30%. So the company pays that 30%, which means that earnings after tax equal 70. Again, assuming 100% payout, the dividend paid is 70. The shareholder tax should be 15, but this 15 should be on the original earnings before tax of 100. Given that the company, the shareholder's company, has already paid 30 in taxes, then what the government does is gives a credit of 15 to the shareholder. So the company paid a tax of 30, the shareholder gets a credit of 15. So effectively the tax rate is 15%, which is the marginal tax rate of the shareholder. This is just another example where the marginal tax rate is higher than the corporate tax rate. In that scenario, the company pays 30%, and then the balance 17% is paid by the shareholder. The third and final tax system we look at is the split rate system. This is called a split rate system because we have a different tax rate for retained earnings versus earnings that will be distributed as dividends. In this scenario, we take pre-tax earnings of 100 and assume a payout ratio of 50%, which means that 50% or 100 will be retained and 100 will be paid out as dividend. So in this example, 100 is retained and the tax rate on retained earnings is 35%. So that is simple. Retained earnings taxed at 35%. And then the shareholder gets 100. In this scenario, the tax rate on the shareholder is 20%. So 20% of 100 is 20. The dividend that the shareholder gets after taxes is 80. Let's say that the shareholder's marginal tax rate is 35%. Then effectively, how much does the shareholder get? On this 80, the shareholder is paying a tax of 35%, so the shareholder ends up with 52. So from the shareholder perspective, for $100 worth of dividends, he gets 52. So what is the effective tax rate? It is 48%. Now we look at a couple of examples from the curriculum, and these examples cover all the factors, or these examples are based on the factors which impact dividend policy. So I want you to read this before looking at the solution. So here is the point. Boar's head should probably not initiate a dividend. And the response is fairly straightforward. The company does not want to raise its debt ratio. The company has positive NPV projects, so it would like its own money to do those positive NPV projects. So read this, but this is a testable concept. Make sure you have a logical sense for when a company should initiate dividends and when it should not. Here is another long one, and I want you to actually read this. It is interesting and it hits on several factors that we have talked about. Here is the solution, and of the factors that we've talked about, there are several factors that come into play here. I'll not spend much time on this because it is fairly self-evident. It's just good practice. We now come to section 4, payout policies. Here we'll talk about the different types of payout policies, the dividend versus share repurchase decision, and global trends in payout policy. There are three broad categories of dividend policies that we'll talk about: the stable dividend policy, constant dividend payout ratio policy, and the residual dividend policy. Let's start with the stable dividend policy. According to this policy, dividends are based on long-term forecast of sales. Dividends are increased when earnings have increased to a sustainably high level. So, in simple words, what a company tries to do is maintain a stable dividend. And if a company expects earnings to be high in the future, then it gradually increases dividends to be generally in line with the increase in earnings. Here is an example of a company which has a stable dividend policy. If you look at 2004 onwards, there has been a stable increase in the dividend per share. Now, the only quirk when you look at the dividend payout ratio is over here. Between 2004 and 2007, the payout ratio has been in the 25% to 40% range. But in 2008, the dividend payout ratio is very high. You can see that the company has been trying to maintain its track record related to dividends per share. And when you look at the details of this company, the EPS in 2008 were lower because of some unusual restructuring costs or some special effects, which is what the company refers to these costs as. The company clearly sees those costs as just being one time and not sufficient to reduce the dividends. So the company is optimistic about future prospects, so it continues its stable dividend policy. When we look at the adjusted EPS, the adjusted EPS would be the EPS without those one-time expenses. Then we notice that the payout ratio is extremely stable, mostly 50% once it is 52%. So this is an example of a stable dividend policy. Taking this one level further, but still in the context of stable dividend policy, many companies have what is called a target payout ratio based on long-term sustainable earnings. Managers are more concerned with dividend changes than with the level of the dividend. Also note that managers will cut or eliminate a dividend only in extreme circumstances or as a last resort. What we are going to look at here is the use of this rather simple expression. Let's say that a company is paying a certain dividend. Let's say that dividend is D. And now earnings have gone up and the company actually expects that this higher level of earnings is sustainable. The question is, should the dividends be bumped up immediately or should the dividends be bumped up gradually? And what most companies do is increase the dividends gradually. So what is the formula for this gradual increase? That formula is shown here. The expected increase in dividend is equal to the increase in earnings multiplied by the target payout ratio. Let's say the target payout ratio is 50%, then this number would be 0.5, and then an adjustment factor. What this means is, if the company says that this gradual process is over 5 years, then the adjustment factor is going to be 1/5. In other words, over 5 years, there will be a 1/5, 1/5, 1/5 factor, so that over 5 years, this adds up to 1. Let's see how this works. This particular company had earnings of $2 a share last year and paid a regular dividend of 40 cents per share. For the current year, the company anticipates earnings of $2. It has a 30% target payout ratio and uses a 5-year period to adjust the dividend. Now, based on the formula that you just saw, I want you to calculate the increase in dividend, and then obviously the expected dividend will be 0.4 plus the increase in dividend. So here is what you do. 0.4 is the original dividend plus the increase in dividend. The increase in dividend, as we saw on the previous slide, is equal to the increase in earnings multiplied by the payout ratio multiplied by the adjustment factor. The increase in earnings is 2.8 minus 2. The payout ratio is 0.3. Adjustment factor is 1 over 5. And when you do the calculation, you should get 0.45. Next policy, constant dividend payout policy. Companies decide on a dividend payout ratio and then apply this ratio to current earnings to calculate dividend amount. This policy and the previous policy both have the term constant in them. So are they similar? The answer is actually they are quite different. Here we have a constant payout ratio. In the previous example, we had a constant dividend, or more appropriately put, a stable dividend. Here, as the term implies, or as this policy implies, all we do is say, okay, we have a particular payout ratio, and whatever the earnings might be, you multiply earnings by the payout ratio and you calculate the dividend. You can do some quick mathematics and figure out what the payout ratio is over here. When you look at the dividends per share relative to EPS, you can see that approximately over this period, the payout ratio is 33%. This method sounds good, but is seldom used in practice because the volatility of dividends per share becomes very high. In fact, the method that we talked about earlier, the stable dividend policy, that is the one that is used by most companies. Because as a shareholder, you are not concerned with the payout ratio, you are concerned with the actual dividend that you are getting. So most shareholders would like predictability and stability. So the stable dividend policy is much more common relative to this policy. The third and final policy that we'll talk about is the residual dividend policy. According to this policy, dividends equal internally generated funds remaining after financing the current period's capital expenditures consistent with the target capital structure. This is a mouthful, but actually quite straightforward. What are we saying? The company generates a certain amount of earnings. So this is the net income. And then the dividend paid is calculated by taking the earnings and subtracting the equity related capital that has to be spent on projects. Let's say that the capital budget is 50, and I'll just work through an example so that you understand what to do, and then I'll make you do some work. So if you have a company where earnings equal 100 million, the company has a target capital structure of 30% debt and 70% equity. This means that if the company needs to spend, let's say, 50 million on a project, how much of this will come from debt and how much will come from equity to maintain the target capital structure? 30% will come from debt, so 30% of 50 will come from debt, and 70% of 50, which is 35, will come from equity. The remaining 15 will come from debt. So then what will the dividend be? The dividend will be 100 minus 35, which is 65. So it is the money that remains after financing the current period's capital expenditures, 50 in my example, consistent with the target capital structure. So this phrase simply means that you take the capital structure into account when deciding how much of the 100 is being spent on your project. Now what I want you to do is say, what if the expenditure were 100 million? Then how much would be paid out? Then it's fairly straightforward. Then the payout would be 70. And if the expenditure is 150, then there will be no dividend, there will be no payout. And here is the calculation from the curriculum. This method is quite theoretically appealing, and you can see why finance professors like this. It connects dividend policy with an earlier discussion on capital structure. But such a policy will mean that the dividend payout is very volatile, and therefore in practice this method is seldom used. But that doesn't mean it's not testable. So you need to be able to recognize this method, and you need to know how it works. So do this now. The correct answer here is A. This is the total amount of money that needs to be spent on capital projects. Equity part is 360 based on the ratio given. 500 earnings minus 360 gives 140. Now this is slightly tricky because in this question you need to read a fair amount of text and figure out which policy is being used, and then based on that policy you then need to figure out what's the most likely dividend. So key here is this term most likely, so give it a shot. So as I said, this is somewhat tricky, but what you need to recognize is that based on the information given, this company seems to be following a stable dividend policy. Therefore, the most likely dividend is €3 because that is in line with what the company has been paying. Now, if you want, you can go look at some of this other information, and you will notice that if the company does pay a €3 dividend per share, it is still in this range. It is probably in the high end of the range, but it is still in that range. So that was the key point over here. In fact, if you think about the sorts of questions that you will get on this material, I'd say that there are two categories. One category is where you'll be given some information and you have to figure out which of the three policies are being used. And then a related category would be, once you recognize which policy is being used, then you should be able to calculate or determine the dividend based on that policy. This question is good because it combines both those elements. Next, we come to the dividend versus share repurchase decision. So this is an important item to think about. A company has two ways of getting money back to shareholders, broadly speaking. One way is for the company to pay a regular dividend. The other way is for the company to buy back shares. You studied this at level 1. I'm not sure whether you remember this or not, but we went through examples at level 1 where we showed that theoretically the overall net worth of the investor is not impacted by the decision of whether to pay a cash dividend or whether to repurchase. So theory concerning the dividend share repurchase decision generally concludes that the share repurchases are equivalent to cash dividends of equal amount in their effect on shareholders' wealth, all other things being equal. That is perhaps one of the favorite phrases used by economists. But all other things are not necessarily equal. So what are some of the factors that we should consider when making a decision between share repurchases versus paying out a cash dividend? Here is one point: potential tax savings. When a company pays dividends, then what do investors need to pay? They need to pay the tax rate on the dividend. If the company buys back shares, then investors pay the capital gains tax. So if those two tax rates are different, let's say that the capital gains tax is lower, then that would lead us towards a share repurchase decision. Next point, share price support or signaling that the company considers its shares a good investment. Generally, if a company believes that its current share price is less than what it should be, then a useful technique used by the company is to buy back shares. And that has two benefits. One is, if the company is right and the shares are actually undervalued, then it's clearly a good investment. And the company knows better than others whether the share is actually undervalued or not. The other related point is that this sends a positive signal. If the company is buying back shares, then the outside world will say, look, if the company believes it's a good investment, then it must be a good investment. So sometimes when share prices are crashing, companies engage in buybacks in order to send out a positive signal. Next point, added managerial flexibility. This connects with something that we have talked about earlier. When companies start paying a dividend, then that sets an expectation that the company will keep paying a dividend. If a company cuts a dividend, that's perceived as a negative signal. So what companies generally would rather do is pay relatively low dividend so that they have the flexibility to use the money on any positive NPV projects or to make investments and so on. And if those investments don't come through, or if the company still has extra money, then it can get the money back to the shareholders by doing a share repurchase. Offsetting dilution from employee stock options. You've seen this at level 1. There was this reading on the income statement where we talked about this particular element. When employees exercise options, what happens to the number of shares outstanding? Goes up. That's dilution. How can a company reduce that dilution? By buying back shares in the open market. Increasing financial leverage. If a company wants to increase its debt to equity ratio, then one way of doing that is to reduce equity. And equity can be reduced by either buying back shares using cash or by issuing debt to buy back shares. And this connects with the discussion that we had in the previous reading related to the optimal capital structure. If a company believes that the optimal capital structure is where debt to equity is 0.4 and currently the debt to equity ratio is 0.3, then a company can engage in equity buyback or stock buyback in order to increase the debt to equity ratio. Now let's look at some examples. So this is example 12, share repurchases to increase financial leverage. I want you to do this first before looking at the solution. So here is what's going on. If this company uses cash on hand to make the share repurchase, the debt ratio would rise to 32%. And if the company uses debt to finance the share repurchase, the ratio would increase to 37%. Let's look at what's happening. Before the buyback, here is the situation. A very simple scenario where debt is 30 million, equity is 70 million, so total capital is 100. And given that total capital is 100, the percentages are the same as the amounts in millions. Now, after the buyback, if the buyback is all cash, then this is what happens. The company is using 7 million of its assets, of its cash, to reduce equity. So what will happen to equity? Equity comes down from 70 to 63. What about debt? Debt stays the same. So what happens to the debt to total capital ratio? That's 30 over 93, which is 32. The other scenario is where the company uses debt or issues more debt to buy back shares. Then debt increases from 30 to 37. Equity goes down from 70 to 63. Now in percentage terms, debt is 37%. In this scenario, the overall company size in terms of total capital does not change relative to the before buyback situation. When a company uses cash to buy back, then the company size becomes smaller. So here is a basic question to check your understanding. If the company wants to aggressively increase its debt to equity ratio, should it use cash or should it issue debt? The answer is the company should then issue debt. If you have time, you can also read example 13, which demonstrates another scenario where a share buyback is used to achieve target capital structure. This is example 14. It is a long example, but I think it is important to go through this example because it is a good indication of what you might get on the exam. Doesn't have too many calculations. It's one of those sorts of questions where you are given a scenario, then people say things, and you are asked to comment or critique what people are saying. So first read this part, and then we will discuss this proposal. The first question I have for you is, given this proposal, are we talking about a stable dividend policy? This is a constant payout ratio policy, or C, a residual dividend policy? If you read this carefully, there is no commitment here about maintaining this number. There also is no commitment about a constant payout ratio. In fact, what they are talking about is that an annual dividend will be paid consistent with retaining funds sufficient to finance profitable capital projects. So when you read this carefully, it looks like C is the best option. Then the next question I have is this. I want you to read this part now. Marshall makes the following remark. The initiation of a cash dividend, which is being discussed here, will suggest to investors that SCII is no longer a growth company. Is this true or false? And when you think about it, this is not necessarily true. It's probably false. The company already has been paying shareholders, not as a dividend, but as a share buyback. So now the company is just changing the mechanism that it's using to get money back into the hands of shareholders. The company continues to invest in R&D. The company is highly profitable, substantial free cash flow. So the curriculum gives you a nice set of bullet points, but the key point here is just because a company initiates dividends doesn't mean that it is running out of good investment opportunities. Then we go on. Here is a counter proposal. And this is the counter proposal. A 2% stock dividend will not affect the wealth of our shareholders. Actually, this is just a remark. Now the question is this true or false? The answer is that this is true. When a company gives a stock dividend, all that is happening is now shareholders have more shares, but each share is worth less. Overall wealth is not impacted. And this again is something that you've seen at level 1, so hopefully you remember that. We are coming close to the end of this reading now. Global trends in payout policy. So this section is called Global Trends, but it is still a very US-centric view. Everything is being compared to the United States. In fact, the first major point made in this section is related to a study that was done in the United States and based on companies in America. The period of the study was 78 to 2000. And what this study concluded is that there are two major tiers of companies in the United States. In the context of paying dividends, tier 1 companies are approximately 100 large, extremely profitable companies that have a fairly stable payout ratio of around 42%. You don't need to remember these numbers, it's mostly just general knowledge for you. And then there are tier 2 companies which do not pay dividends. Of the companies that do not pay dividends, there are two reasons for why dividends are not being paid. One reason is that a company is, or these companies are financially troubled and maybe just marginally profitable, or maybe they are losing money. So clearly such companies cannot pay dividends. And the other more interesting category is companies related to technology that typically use share repurchases as a substitute for dividends. So if you think about companies that were created roughly in this time frame, companies like Apple and Microsoft and Oracle and so on. So those companies became extremely profitable, but they did not pay out dividends because they had lots of investment opportunities. Now we take a little bit of a global perspective and look at companies outside the United States. A lower percentage of companies in the US stock market have paid dividends than have companies in comparable European stock markets. So what we are saying is, if you take the US stock market and comparable companies in the European stock market, then by and large, European companies tend to pay higher dividends. The third point, the fraction of companies paying cash dividends has been in long-term decline in most developed markets. And given some of the reasons that we talked about, this does make sense, because if a company is paying a cash dividend, then that sets a precedent. Whereas if a company does share repurchases, then that gives companies a lot more flexibility. So by and large, across the developed world, there is a trend towards buyback of shares as opposed to paying cash dividends. Since the early 80s in the United States and early 1900s in the United Kingdom and continental Europe, the fraction of companies engaging in share repurchases has trended upwards. So these 2 points actually go hand in hand. All right, final section of this reading, analysis of dividend safety. I'll set the context and then I'll describe how this analysis is done. Let's say you are a financial analyst and your clients are very concerned with the level of dividends that they get, and the potential risk is that companies might cut their dividends. So how do you study companies and determine whether there is a relatively high or relatively low probability that the company will cut dividends? A traditional measure used to determine whether or not a company is likely to cut dividend is to look at the dividend payout ratio and its inverse, the dividend coverage ratio. You are very familiar with the dividend payout ratio. This is simply the amount of dividend divided by earnings. The inverse, which is called the dividend coverage ratio, is earnings divided by dividends. If you look at example 15 in the curriculum, this is one of the simplest examples you'll ever see. We are given a company where earnings equal 100 and the dividend paid is 40. So what is the dividend coverage ratio? It is simply equal to 2.5 times. So the earnings are 2.5 times the dividend. So what makes you feel safer? A relatively high coverage ratio or a low coverage ratio? Obviously a high coverage ratio makes you feel safe because that means that the company has a relatively high earnings number relative to the dividend number. If this ratio starts coming down close to 1, then that is a warning sign, because as the ratio starts coming down, that means that the company is paying all its earnings as dividends. And if this ratio dips below 1, then that would be a major red flag, because it will be very hard for a company to sustain a dividend level that is higher than earnings. So this was the traditional measure. A more comprehensive measure is the free cash flow to equity coverage ratio. And why do I say more comprehensive? When you think about the traditional measure, it is looking at earnings, not at cash flow. So it would make more sense for us as analysts to also consider the investments that companies need to make in working capital and fixed capital. Because ultimately, if a company is not making those investments, then it will not do well in the long run. So the free cash flow to equity number for a given period takes into account working capital investments as well as fixed capital investments. We have seen this in FRA, and we'll see this in a lot more detail in equity, but just take this as a given for now, that free cash flow to equity is a measure that says, okay, after making the necessary investments, here is the money that we have available for equity holders. So with this coverage ratio, we look at FCFE divided by all the payments that are being made to shareholders, be they in the form of dividends or be they in the form of share repurchases. So you can see that this is a more comprehensive measure and arguably a better one relative to the traditional measure. So is a high number good or low number good in terms of dividend safety? Again, a high number is good because you want the free cash flow to equity to be relatively high compared to the denominator. So what is relatively high and what is relatively low? Clearly, if these coverage ratios are high relative to the industry, then that will be a good sign. So as with any other ratio, you can do a time series analysis or a cross-sectional analysis. A time series analysis would be that, okay, compare the ratio relative to the ratio for the same company in the past and see whether it is trending up or trending down. If the ratio is trending down, then that will be a warning sign, especially if the ratio is coming close to 1. In fact, what does a ratio of 1 mean here? A ratio of 1 means that all the free cash flow to equity is being given out to shareholders, so the level of flexibility is low. A ratio of greater than 1 means that the company is paying shareholders but also keeping some money in the bank, and that gives the company some cushion, some flexibility. A ratio of less than 1 would be very scary. You can also compare with the industry or peer companies to get a sense for how much this company is paying relative to peer companies. If the ratio is much less than the ratio for peer companies, then that would be a warning sign. You can also look at the stage in the industry life cycle. If you have a company that is relatively young in an industry that is relatively young, then what would you expect the ratio to be? Then you would generally expect the dividend payouts to be relatively low. So key point is this, however. Now this is example 16, which discusses the coverage ratios in the context of Harley-Davidson. And I'm not going to go over the details here. I want you to work through the numbers. The solution is given on the next slide, but the calculations are fairly straightforward. You are given the numbers, so you can find the dividend to earnings payout ratio, the earnings dividend coverage ratio, and then essentially the free cash flow based coverage ratio. So it's just very basic calculation, and then you can look at the trend. The reason I find this interesting is that an analyst who carefully did this analysis could actually predict what happened later. So there is a small update at the end of this case study which says that, look, these ratios were progressively becoming worse, and after these numbers, so 1 year later, the company actually cancelled or brought its dividends down to 0. So nothing too difficult, but still you should go through this case study. We are done with the reading. Now let's just do a quick summary of the main points. The first major point was the 3 different theories related to dividend policy. One was the dividend irrelevance theory proposed by 2 favorite finance people, Modigliani and Miller. So what they essentially said is that under a certain set of restrictive assumptions, the value of a firm, the total value, which is debt plus equity, so the total value does not change based on dividend policy. Then the second theory was the bird in hand theory, which basically said that investors prefer getting dividends as opposed to retained earnings. So according to that theory, companies that actually pay out dividends would have a better valuation. And then the third theory was the tax argument, which said that if our tax structure is such that dividends are taxed at a higher rate, then companies which pay lower dividends will have a better valuation. Next point was the signals associated with changes in dividends. This is not a hard rule, but simplistically, if companies are paying a certain level of dividend and then that dividend is increased, or if a company hasn't been paying dividends and now it starts paying dividends, this is generally perceived as a positive sign, because an increased dividend is sending a signal that the company expects to make more money in the future. If a company reduces dividends or stops paying dividends, then that is generally perceived as a negative signal. Then we talked about the clientele effect, and what this says is that different investors will have different preferences in terms of dividends. Some investors will prefer getting dividends, especially older retired people who want a stable income flow. And then there'll be investors, young professionals with good jobs. They will probably prefer capital gains because they don't want to pay dividend related taxes. What are the factors which impact dividend policy? We went through a list of factors, but the volatility of earnings, the possible investment opportunities are two classic areas which impact dividend policy. Then we talked about the different tax rates related to dividends, and here again there were three different tax rate systems. One tax rate system was the double taxation system, where there is a tax at the corporate level and then there's a tax at the shareholder level. The second was the tax imputation system, where we basically said that effectively the shareholder is taxed only once. And then a split rate system, where there is a tax on retained earnings which is different from the tax on what is paid out to shareholders. So then obviously there is also the tax on the shareholder when he gets the dividend. Stable dividend, constant dividend, and residual dividend policies. Stable dividend means that companies try to maintain their dividend. If earnings are going up, then companies try to increase dividends in a stable manner in line with expected future earnings. The constant dividend payout is where the company tries to maintain a payout ratio. But the issue with this is that the actual dividend payout, the amount in dollar terms or euro terms, will be very volatile. And then the residual dividend policy, which basically says that, look, we have a certain amount of earnings. We first spend money on our own projects based on our capital structure target, and then what is left is paid out to shareholders. Choice between cash dividends and repurchasing shares. The high-level theoretical argument is that it doesn't make a difference, but when we get into the details, then depending on different tax rates and depending on the amount of financial flexibility that a company wants, in many cases, repurchasing shares makes more sense. And in fact, when we talk about trends in dividend policies, then by and large, the trend seems to be that cash dividends are decreasing and buybacks and share repurchases are increasing, especially in the developed economies. Analyzing dividend safety, here we talked about two ratios. The traditional ratio that simply looks at earnings over the amount of dividends paid, and then the more comprehensive ratio which looks at free cash flow to equity over the total amount of money paid to shareholders. As always, I want you to read the summary, review the learning objectives, do the examples. There are lots of practice problems, and do them. One word of caution, that these practice problems, some of them are not exactly case study format. You are just given level 1 style questions, but still they are important at testing concepts. So make sure you do those, and if you have time, then practice questions from other sources. That is it.